Welcome back, and another month further on in the journey to hopefully financial freedom for myself. At the end of last month, I mentioned that I might be investing into a brand new company, which I have done that, but not until really close until the end of the month, so about a week ago on the 25th of September. But before we get into that, let me just give you a brief update on the macro events that happened since the last month's update, since we last spoke. Core CPI, one of the indicators that the Fed use, came in slightly hotter month over month than expected. It came in at 0.3% against expected 0.2%. That might sound bad, but actually it's not, as it shows that the economy out in America is still strong, and hopefully they can avoid a recession, which would have the biggest effect on my holdings in my portfolio, as the majority of their money comes from the American economy. As expected, the Fed held rates at 5.5%, so there was no hikes in the interest rates in the US at the end of September. Core CPE, month over month, came in at 0.1%, which was below the 0.2% that was expected. That is good news, but still, as you can see from the graph here, it's maybe what you would call sticky, and it's not coming down at the rate that which many would like. Personally, I think this therefore means we could see the Fed hold rates at the level that they're at now, elevated, until probably nearly the middle of next year, as we glide down to what we would class as acceptable levels of inflation, or the target of 2% that the Fed has. So let's transition across my portfolio and what I've actually bought. I invested a further £5,000 into my general investing account this month and bought a pretty well-known company called Mastercard. Why Mastercard, you might ask? Well, the dividend payout ratio is just over 20%, so it's got a healthy dividend payout ratio with room for growth, which they've been increasing their dividend payout on average by 18% each year for the past 5 years. Yes, the starting yield of the dividend is only around 0.6%, but if Mastercard management continue to grow the dividend at the 18% a year that we've seen, in just over 4 years, this means that the dividend will actually double. As a company, they're basically in a duopoly with Visa in the payment market space, and I personally believe that Mastercard has a larger runway for growth over the next few years than Visa. Mastercard have managed to grow their free cash flow, which ultimately is the king of why we're investing. As a shareholder, you want masses of free cash flow. They've been compounding that at 13% over the past year, and over the past 5 years on average, whereas Visa have only managed to increase theirs by about 10%. I do like it when a company that's in the mature stage of its life cycle, which Visa and Mastercard are in, are regularly buying back shares, therefore increasing my slice of the pie and the ownership of the business without me actually having to buy any more shares. Both Mastercard and Visa do that every single quarter, and they have done for many years now. Mastercard have bought back 9.6% of the total outstanding shares since 2018, compared to 7.6% that Visa have bought back. This has had a positive knock-on effect in terms of EPS growth for both companies, but Mastercard have managed to increase their earnings per share, EPS, by 83% since 2018, compared to Visa, who've actually only managed to increase theirs by 58% for the same time period. The slight concern I might have with Mastercard is that the amount of debt that they're taking on to fund and push some of their growth initiatives, considering the rates that the Fed have increased to recently. But I do think that the management that's in place have shown and will continue to show that they can deploy and gain high returns on equity and capital for the business and ultimately the shareholder, which I'm now one of. Taking a step back, I could own either Visa or Mastercard, really. But to me, Mastercard has more growth prospect and the PEG ratio is better, lower. So it's more value, if you want to call it that. and that is basically how much you are paying for future growth. So the closer to 1 or below 1 is best. MasterCard currently trades at 1.3 PEG ratio compared to Visa around the 1.6. Moving on to Tesla news, literally an hour or two ago they released their Q3 production and deliveries, actuals. It came in below Wall Street's expectations of 554,000. They actually produced 430,000 and delivered 435,000. Management reiterated that they would deliver somewhere around 1.8 million for the full year of 2023, which means that they need somewhere in the region of 476,000 in the final quarter, Q4. Earnings have been announced and will be in 2 weeks on Wednesday, so the 18th of October. So in summary, my portfolio now consists of 3 companies. Tesla, which is by far my biggest holding. Then Google, which I invested in back at the end of May now. And then finally MasterCard, which I bought into the month just gone, last month, September. At the start of September, my portfolio stood at a combined value of £154,358. I've personally invested a further £500 that I've mentioned above now, and the closing balance at the end of September for my portfolios combined, both my ISA and general account, is £155,671. So an overall increase of £1,313, of which £813 of that is growth, somewhere in the region of 0.5% growth for the month. As we're nearing the end of 2023 already, where has this year gone? Well, I suppose we say that every year, to be fair. I think that in next month's episode, so end of September, beginning of October, I will reflect a bit on how my investment journey has gone over the past kind of few years and show you a zoomed out view of looking at how much I've lost over that time, gained over that time, the ups and downs, as well as what I've personally learned along the journey so far. If you've liked this update, then please do 1, like this video, and 2, subscribe to the channel to find out how I get on with my journey in the future. But until next time, stay safe.